The inflation numbers are finally cooling off, and the Federal Reserve is actively cutting rates. In theory, things should be getting easier. But if you look at your own bank account or try to buy a house right now, financial conditions still feel suffocatingly tight. We're seeing symptoms of severe strain everywhere. Mortgage rates simply refuse to fall, keeping the housing market completely frozen. Meanwhile, the stock market is prone to random, violent flash crashes that seem to come out of nowhere. If you turn on financial news, analysts are hyper-focused on Jerome Powell and the U.S. Federal Reserve. They obsess over every press conference as if the Fed has total control over global liquidity. But the truth is, the primary lever dictating the price of money is nowhere near Washington, D.C. The real foundation holding everything together for the last 30 years is located in Tokyo. Specifically, it comes down to the mechanics of the most boring asset on Earth, Japanese government bonds. Japan has quietly functioned as the duct tape of the global financial system, and right now, that tape is starting to peel. To understand why Japan matters so much to your wallet today, we have to rewind to 1992. That's when Japan's massive asset bubble burst. Real estate collapsed, equities crashed, and the economy entered a grueling 30-year period of zero growth, known as the lost decades. The central bank had to do something to stimulate growth, so they slashed interest rates to zero. When that didn't work, they actually pushed rates below zero. This chart illustrates a policy called yield curve control. They placed an absolute cap on long-term government bond yields. The Bank of Japan permanently pinned interest rates to the floor, actively fighting against any market forces trying to push them up. This created a massive problem for domestic institutions. If you're a Japanese pension fund managing billions, a 0% return means you can't pay retirees. To survive, these institutions were forced to look elsewhere for returns, sending their money overseas. This desperate search for a decent yield turned Japan into the most aggressive exporter of capital on the planet, effectively making them the world's ATM. This visual breaks down how investors exploited this setup, creating the yen carry trade. Investors borrow Japanese yen for practically nothing, convert those funds into US dollars, and buy United States treasuries yielding around 4%. After fees, they simply pocket the spread. When borrowing money is essentially free, investors get hungry for even bigger returns. This massive flow of capital quickly overflowed the government bond market. It splintered out, aggressively flooding into U.S. tech stocks, real estate, and corporate debt. The sheer scale of this trade is staggering. Trillions of dollars flowed through this pipeline, making Japan the largest foreign holder of U.S. debt, and acting as a massive hidden engine for global market liquidity. But this entire multi-trillion-dollar machine had one glaring vulnerability. The math only works if you assume Japanese borrowing costs will remain at zero forever. In 2024, that assumption broke. The Bank of Japan officially ended yield curve control and hiked interest rates for the first time in 17 years. The domino effect was immediate. Borrowing in yen became more expensive. Hedging against currency fluctuations spiked. The core math simply evaporated. When the math flips, the capital flows flip with it. We are now seeing an event known as repatriation, where Japanese money rushes back home. The cheapest source of liquidity in the world is actively being sucked right out of global markets. To see the immediate fallout from this, we have to look back at the United States. The U.S. government runs trillion-dollar deficits every single year. Just to keep the lights on and fund basic operations, the Treasury has to constantly issue massive amounts of new debt. This chart highlights a severe supply and demand problem. For decades, Japan reliably absorbed a huge chunk of this debt without worrying too much about the price. Now that they are stepping back, the U.S. Treasury is staring at a growing pile of bonds with a sudden lack of buyers. To fix that imbalance, the market demands an incentive. The only way to attract new buyers to absorb this mounting debt is to offer them higher returns on long-term government bonds. This specific dynamic completely hijacks domestic monetary policy. Jerome Powell can cut short-term interest rates all he wants, but because the global supply and demand for debt is heavily skewed, long-term bond yields stay stubbornly elevated. And that 10-year Treasury yield is what directly impacts your wallet. It effectively sets the baseline price of money. If that yield refuses to drop, consumer borrowing costs, especially your 30-year mortgage rate, are structurally blocked from going down. The pain ripples outward. Elevated long-term yields choke off access to the cheap corporate credit that businesses rely on to grow. When borrowing gets expensive, corporate expansion slows down, and stock market valuations compress because investors demand higher returns for taking on risk. True financial literacy means looking past the loud, clickable headlines about the Federal Reserve. The multi-decade era of cheap global liquidity has ended. The most severe threats to your wealth aren't the dramatic talking points on the news. They are the silent, systemic shifts in capital happening entirely out of view.